Just this week, we had Moody's Analytics lower its outlook for U.S. economic growth this year and next, and saying that it sees significantly weaker prospects for the economy, compared to what it was a month ago. The big debate at the moment centers around whether or not we're seeing the U.S. possibly venturing into a recession. What's your view?
Well, we think the stock market right now, as it is priced, is probably built in close to a 40% probability of a recession. I don't think it's any more than 20%. So 4 and 5 odds within the next 18 months, we will not be in a recession in the United States.
So what is your expectation then around real gross domestic product growth for the second half of this year?
Well, we had a pretty disappointing first half, as you know. We think with the oil prices coming down and a recovery in automobile output because they can get their parts from Japan again, that you'll probably have GDP growth around 2.5% in the third quarter and 2% in the fourth. Next year, we're looking for 2.3% growth. That is disappointing in the sense that we have the potential to do so much more in the United States. We have the spare resources, but we're not going to have the kind of policies that allow us to do that.
Of course, it's also disappointing where this has been labeled a jobless recovery. We're looking at projections of between 2.5% and 3% growth that's actually needed to add jobs fast enough that would keep that unemployment rate stable. And that's certainly something that's not going to be happening anytime soon on a sustainable basis, at least. So the headwinds are strong at this stage of the game.
Well, there are certainly headwinds in the sense of we need a more stimulative fiscal policy, and we're not going to have it. There's a headwind coming out of Europe because you're having all sorts of financial problems in Europe, and you will have fiscal austerity in Europe. Those are the headwinds. Fortunately, there are some important developments in the U.S. economy that suggest that we probably won't go into a recession. Most importantly, U.S. recessions are kicked off either by money becoming too expensive or unavailable. And neither of those is happening in the United States right now.
Let's take a look at it then and unpack, the credit system. Is it functional enough at this stage? Let's delve into the status in that regard.
So the credit system is what I would call satisfactorily functional. In other words, there's enough credit to keep business moving forward. There isn't enough credit to give us a boom because we still don't have anything close to normal credit availability when it comes to the mortgage area. That's one part of the economy. That's the major reason for a slow recovery is the housing industry's inability to recover. However, outside of the housing area, banks have been easing lending standards for the businesses and for non-mortgage consumer borrowing, and the data show that in fact businesses are borrowing that money, putting it to work slowly but surely, and that consumers have started to borrow money again and are beginning to spend more.
Let's take a look at the consumer, because I came across some commentary yesterday saying that it's as simple as it being a change in attitude, and that can be the difference between a slowdown and a recession. That, of course, where we've got 70% of U.S. economic activity dependent on the U.S. consumer. What's your view on commentary like that that's out there?
Well, the consumer, of course, always is pivotal for the economy, and my experience is that we have to distinguish between the public expressing dissatisfaction with the politics, as you're seeing in the public confidence polls and in the consumer confidence polls in the United States, distinguish that disappointment with the political process with what people actually do with their money. That July last month was a month where the consumer sentiment indices were weaker. There was a lot of disgust expressed about the failure to have an agreement on the budget on time. Having said that, people still spent more money and they borrowed more money.
Taking a look at the figures on that front, I mean, we had consumers actually spending more on more than expected in July, and that was on discretionary items, pushing retail sales up 0.5%. Let's take a look at some of the support factors that are currently at play for the consumer, because top of mind on my mind specifically would be that we've had that oil price coming back, and that would effectively put for one more cash in the consumer's pockets.
Well, you've identified a very important fundamental with lower gasoline prices. We estimate that through last spring, the increase in gasoline prices was probably picking the American consumers' pockets by about $100 billion a year. But the other things that are happening is that credit has become somewhat more available. The consumers are borrowing, and what is also happening is that although the job picture has been disappointing, the jobs that have been created have been pretty good jobs. So that when we look at the average hourly earnings over the last 3 months, they're up at about a 3.5% annual rate. And that's not because of very fast wage inflation, it's because at the margin, we've been adding good jobs.
Are the American consumers becoming too reliant on government assistance programs? I mean, we had Walmart out with its results earlier this week saying that, 19% of Americans are relying on food stamps. They're becoming more reliant on government assistance, and that because they're so worried about employment prospects moving forward. If so, just how much of a danger does that present?
Well, I think it would be certainly hurt companies like Walmart, and it would be bad for the economy if we were to cut back on those assistance payments to the less fortunate. I don't think that we'll end up doing that. I think what's more important is, in terms of consumer spending, is for the big percentage of the economy, the 92% of the workers, 91% of the workers who have jobs, and their attitudes towards spending, and they're moving ahead with their spending, slowly but surely.
Let's take a look as we wrap this discussion up, at policy specifically. I mean, the Fed last week decided to keep interest rates extremely low for the next 2 years. What have you made of that move together with the raising of the debt ceiling? And what's the most important thing U.S. policymakers can do at this stage to save what is a battered economy?
Well, what the Fed needs to do is to keep on what it has been doing, keep the system liquid, keep interest rates very low. They've done a very good job of that, but that's about all they can do. On fiscal policy, at the very least, we need to extend the expiring tax cuts at the start of January. This year, we've had a 1-year reduction in the Social Security tax withholding. That expires at the end of the year, and the President has already said that he wants to extend that. We at least need that out of fiscal policy. In the best of all worlds, we wouldn't think about politics, and we'd probably have a big tax cut to stimulate the economy, but the politics are such that that's not going to happen.
We've heard a lot of speculation around quantitative easing 3, even amidst all the criticism, of QE and QE2, and that they weren't effective in the first place. Do you see us venturing down that path?
I don't think the economy would be quite weak enough to justify a third round of Fed balance sheet expansion, what we call the QE3. If I'm wrong, in the next couple of months the economy weakens, if they need to do it, then I think they will do it. Although what we're seeing is that if they have QE3, the Republicans could be very critical of that, because they could be saying the Fed's trying to help out President Obama in an election year. So like everything else in the United States, that's pretty controversial.